Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. In today's EIA show, we're going to follow the normal pattern of overview, refined products, and then exports, and then looking into the international markets. We're going to touch a little bit on OPEC, but we're going to do a special OPEC show on Friday. We were hoping to do it today, but obviously with them delaying the final meeting to Thursday, December 3rd, obviously that throws things off a bit. And we'd also like to remind you, please like, share, subscribe. We also have a big report coming out, and you can click the link here in order to see what the report's about. If it's something you're interested in, we're going to be looking at all horsepower, supply, active spreads, marketed spreads, what's actually out there, and then we're also going to do a big backdrop in NGLs, pipes, and then what to expect going into 2021. So now that we covered that, again, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So looking at the crude stock draw, it came in at 680,000. It was a little bit better than what was expected. The estimates were coming into today about 1.9, a draw of 1.9 million, but it was below the build of a little over 4 million from the API. So again, it's just going to be timing with API and EIA, just because there is a way to calculate it, but the API isn't something that is mandatory. So sometimes there'll be some differentiating factors between that. But when we look at the actual numbers here, so we did get a draw of 680,000. Again, not as much as it was expected. The SPR was flat. We're pretty much at the end of where we would get additional draws out of the Strategic Petroleum Reserve. The bigger component was we did see an increase of 100,000 barrels a day in production up to 11.1. Now, this is where it gets interesting, because we were expecting going into the end of the year to have an exit rate between 10.5 and 10.7. And for those that are loyal watchers that have been following our Frac Spread Count show, clearly we're wrong. I mean, right now the Frac Spread Counts are increasing. They're really getting aggressive, going after the decline curve. So at this point, we're going to have to take that number up. 10.5 is definitely too low. It's going to probably be something closer to 10.7, 10.9 now. I'd like to say that it's going to be 10.7, but again, as long as the activity continues to remain at this pace, it's going to be hard to get to the lower end of that range. The one thing that we've also been talking about is Cushing. Cushing had a small draw of 320,000. Again, it's just going to be timing in terms of when does that come through, when does that come out, and it's just going to be something that we're going to have to keep our eye on as we have production continuing to increase in the U.S., or at least remaining elevated throughout the U.S. And at the same time, we also have coming into Pad 2, we have a decent amount of new imports, and it's just going to be what is the timing delay? Does it make sense to go from Cushing to the Gulf Coast, or how do those dynamics really look, which is something that we'll continue to look at and talk about as we go forward. So looking at just, again, the total inventory, this is including the SPR. You can see that we're pretty much flattish. If we use the 5-year, we're just above the 5-year average, and we're just kind of hanging sideways once we include the Strategic Petroleum Reserve. And we just like to look at both just to kind of weigh, what is happening. Does it make sense? And now when we turn to Cushing, you can see that we're right back within the seasonal average, and I think this was really going back into 2016, 2017 when we started to push back higher. Here we think that there's going to be enough flow coming in that we're just going to continue to go sideways, which again will keep some pressure, or at least cap a bit of the WTI run that we've seen. But there's also something to consider when we're talking about WTI Cushing pricing and the U.S. dollar and what's happening with the underlying bids on a global level. But this is going to be something that is, you can see that we're still fairly elevated to April, but with just, Pad 3 drawn down a little bit more versus where we were. And again, there's nothing to really say that we're going to surge to the to tank tops. But again, there's also nothing to say that we're going to get a big drain to the downside, putting us essentially going sideways and starting to to keep those WTI Cushing prices fairly capped. Now, when we take out the SPR, this is commercial stock. You can see that we're just hanging right just above that 30-year or so average. Again, nothing to say at this point that we're going to go down or up. It's just something that is going to be a bit more to the sideways. Exports did have a big increase, which did help pull some of the additional crude out of storage. And even with that, you can see that we're still sitting at a fairly flat rate. And it's because when we look at this on an aggregate, we had a little bit of an increase in imports, we had a big increase in exports, and we had a small decline in refinery runs, which essentially kind of balanced this out. So even though the export side was fairly bullish, we did, or I should say, was going to pull more from storage. We did have a cut in refinery runs, we did have an increase in production, and we did have an increase in imports to help kind of offset that, which is what resulted in where we sit now. And here you can see PAD 3 remains elevated. There's, again, just kind of going sideways. PAD 3 did have the biggest decline in refinery runs, which is something that we were talking about last week. And now that we're on the other side of Thanksgiving, we should start to see some of that, some of those runs come back online. And really already have, depending on timing. It's always just a matter of when does it report, when does it go online, is it Saturday, Sunday, Monday? These are things that were that just it's hard to pinpoint, but at the same time, it's just it's just a day or two. So when we're looking at imports, PAD 1 was down. It's something that's going to be fairly lumpy, but typically, when we show what the PAD 1 imported specifically on a gasoline and distillate level, this will make a bit more sense. And then PAD 2 continues to see their imports stay fairly strong, especially against the 5-year average. And as we talked about, we thought it was going to just kind of track that 5-year increase. PAD 3 was fairly flat, not too much up or down, and it really married with the reduction in refinery runs. And the other PAD 4, PAD 5, something similar, just a bit more timing. PAD 4 had a nice little increase, but it normally starts to pull a little bit more in, especially as we get closer to winter and the demand for heating oil increases. So that's something that we should see stay not at those levels, but again, staying within seasonal averages. Now, when we look at runs, it declined by about 50 basis points, so 78.7 to 78.2. We still think that we're going to get to about 80% utilization rate. You can see most of it was really carried by PAD 3 and PAD 5. PAD 3 will come back again, all because of just timing. The issue that's going to continue to be a problem is demand. We saw a big build across diesel, across distillate, across gasoline. And these are things that we have to look at, especially as we're watching some of the crack spreads come under pressure. So there will be enough demand to bring back, I think, to, let's call it another 2 percentage points. It's just getting past that is going to be very difficult given where prices are for crude. So that when we're looking at prices of crude, what are the differentials? What does that look like? And then what's the margin on the other side, which is going to really limit how aggressive these refiners can get. And when we look at the implied demand, this is what we're talking about when we're trying to balance out, well, how aggressive can they get? How much increases can we see? And gasoline declined by 156,000 barrels a day. Now, when we talk about Gas Buddy in the next segment, Descartes, this is going to see another leg down, and it's just because of looking at different timing components. So Gas Buddy's looking at the purchase, so looking at the pump. Descartes Labs is following cell phones, and then this is following from storage to the rack. So when we put this all together, you can see that there remains softness. We're going to continue to see declines, and realistically, we should see another step down, just given some of the data that we've seen with a very soft Thanksgiving driving season. Distillate, as we talked about, going to be lumpy. It's still strong on a year-over-year level and a 5-year average. So there's really, even though it looks big, we had obviously Thanksgiving. We had which dropped trucking, put a little bit of pressure into rail. But again, these are things that were expected, and it's something that we think is just going to, really kind of snap back, and we'll still see distillate stay fairly strong in terms of a demand level within the U.S. Jet fuel, again, something that's going to stay under pressure now that we see some of the flights coming off after Thanksgiving. Propane is one that we think is going to remain strong. It's going to be a big part of our report coming out in the next week or so. So again, just a reminder, just to look for the report, see if it's something that you're interested in, because we're going to do a lot on LPG and just NGLs within the U.S. and as well abroad, because we think that propane is a bright spot, if you will, in the energy space, which has come under a lot of pressure. Looking at Gulf Coast crude oil floating, like we said, we're just going to bump along the bottom. There's really, with refinery utilization rates sitting at about 80%, 78, 80%, there's really no reason to keep floating storage, just because we can just keep things moving on a fairly timely level. And again, it'll probably increase just because we do have some shipments that are coming in, and it's just, this is going to be used as a timing delay, just because if we have the storage available, why keep it on a boat where it's more expensive? So they'll try to put this into onshore storage as quickly as possible. And again, as we talked about with imports, we fell down out of the bottom in Pad 3, which it just comes full circle back to just marrying with refinery utilization rates, just because they're looking at ways of managing the blends, trying to create the best basket of crudes, of refined products with the crudes they have available, which is something that we're going to talk about in a bit more detail as we go into the second segment. So here, the imports into Pad 2, you can see that as we look at the 5-year average, it's tracking just above that 5-year component. There's nothing to say that we won't continue to follow that spike that we normally see. Again, nothing that is shocking on a seasonal level as we normally see these increases. It's just slightly above that 5-year average, which is just coming from Canada, trying to adjust some of the flows. So there's really nothing to say that that's going to adjust in the next week or two, which again will support imports into Pad 2. This is the one that we continue to highlight just on when we talk about global oil demand. You can see that, the U.S. is one of the largest, well, I should say, is the largest refiner of crude oil, with China essentially, depending on timing, how quickly they can get to, I think within the next 3 to 5 years, they'll be able to either match or overtake the U.S. in terms of actual capacity. Not to say that the utilization rates will be the same, but again, just something to consider as we look at where is the oil demand really being driven. Operating at these levels is a big headwind for total oil demand as we go forward. And when we talk about in the third segment, we'll talk a little bit about China, about some of the utilization rates, but also in the report coming out, we're going to talk a lot about Chinese refining, petchem, because it's just going to be interesting in terms of the new trading dynamics. We're seeing trading lanes change, we're seeing flows change, which is going to have ramifications that are going to expand way more than just a quarter or two. I mean, this is a multi-decade shift that we're continuing to see, and we truly have to appreciate in terms of, well, where does the U.S. fit in, and how can we continue to make money and continue to maintain our ability to not only just make product, but make product profitably, because that is going to become a bigger and bigger issue as pressure remains, what we think is going to be through at least the first half of 2021. And, OPEC is obviously trying to figure out ways to work within that and to try to protect pricing to a certain point. But the more you protect pricing, the more you're going to hurt refiners, because they don't get demand on the other side. So prices of products remain depressed, and then the price of feedstock remains flat, and the differentials just really don't work, which is just keeping them from really ramping, which is going to be an overarching problem that we'll continue to look at and address on a crack spread level, and kind of show when things are adjusting. But so far, they still remain under some significant duress.